Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
What's up, everybody? Anthony Crudele here, and thank you for tuning in to this month's Best Moments episode. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. Remember, new shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. If you're enjoying the show, please leave a review on iTunes. This show is also sponsored by Trading Technologies, FTSE Russell, and RJO Futures. It was another busy month on the podcast, so I took all of my favorite clips from each episode and put them into one episode for you to enjoy. So without further ado, let me take you to our best moments from last month.
I've been a big bull in gold and silver for years and remain so. And I think silver in particular is probably, in my opinion, the most compelling asset in the world right now.
Okay, why?
So the silver has been weighed down over the past couple months because, some days it trades like an industrial metal, since half of its use is pretty much industrial metal demand. Right now, a lot of that demand used to be film and cameras. Now it's solar panels, electric vehicles, batteries, electronics. So when the global economy collapsed, self-induced, of course, then you saw a big drop in the demand for silver. But then you have times when silver has a 4,000 year plus history of being a monetary metal and being a form of money, which gold pretty much always is because of the very limited and tiny industrial uses that gold has. So now you have this disconnect where going back to the mid 1970s, call it 1975, let's just say, the average, and it's been above, it's been below, the average gold to silver ratio is about 60 times. Well, in March, that ratio got to 120 times. So double the normal average. So now this is art, not science. It's a very simplistic way of sort of valuing silver, but because of thousands of years of monetary history, you could still measure the relationship between the two precious metals and see how quote unquote cheap silver is relative to gold. And now that you have the global economy, which I think is going to recover gradually over the next coming quarters, just for the sole purpose of when you reopen, you will certainly perform better than when you're closed, that silver will start to get back the benefit of being, yes, an investment metal and a monetary metal, but also as demand picks up for its industrial uses, silver has a lot of opportunity here to catch up to the price of gold, with both still going higher, but silver moving more higher from here at an accelerated rate relative to gold.
A famous story was I was standing in the Eurodollar pit, and in came this young blonde-haired kid. Walked out of the options pit because I stood right at the options pit. He literally stepped into the futures pit, and he asked where front month futures were, and it was this young kid. And all of a sudden, everybody screamed the market at him, 1-2, 1-2, or I can't remember the exact quote, but he started buying 1,000 lots from various large traders in the pit, and everybody kind of looked at each other and said, "Who is that guy?" And then somebody turned to somebody and said, "That's Doogie." And everybody's like, "Well, who's Doogie?" And then sure enough, that person was Don Wilson, who's the founder of DRW Trading, and it was him hedging a very large options position that he had just put on in the options pit. He came into the pit to hedge it himself rather than give the order to a broker. But it was one of those moments where, it doesn't matter what you look like or who you are or how big you are, because, there was a lot of time where liquidity providers went not to the biggest order in the pit, but to the tallest guy in the pit, because brokers could see over the crowd, and the tallest guy in the pit would have his hands up, and he would absolutely get the trade because brokers could actually physically see him. So it was interesting that, kind of dynamite and order flow can come from all sizes in open outcry. So I thought that was just a really interesting moment to see that actually happen.
Yeah. And we talked a lot about how you've been through transitions, and I'm so thankful for everything you've done to transition from pit to screen, because I am really somebody who was able to start and see the pits and see how the markets work before the screens. But once the screens became available to us, as you know, I was one of the very first screen traders. And for me, it just provided such a great opportunity for someone like myself who wasn't tall. And when I stood in the S&P pit, I was actually in one of my recent podcasts, I was talking about, I stood in front of Earl. I don't know if you may or may not Earl, but Earl's 6'8". And every time I turned around, I was like looking into a wall of a man. I'm like, nobody's ever going to see me, let alone trade with me. So it was, I'm so thankful that we are on electronic markets to give me the opportunity to have a career in trading. I say, actually, every time I see Leo Melamed, who you and I talk to all the time, every time we see him at a conference, I always go up to him and shake his hand and go, Leo, thank you so much because you gave me the opportunity to be a trader on the screens, and he's always so grateful and gracious every time I see him.
Yeah, Leo brought Globex. Leo was the incredible mind that brought that electronic system to CME Group. Just a really exciting person. You feel proud of being in the industry when you shake his hand and you share stories with him. And talk about an active trader. That man, I'm sure he's still an active trader.
Oh, when I was in his office a couple of years back, I go in, he just puts his finger up for a second and goes like, be quiet. And he was talking about something he was doing with the market. In his office, we talk about a piece of history. His office is unbelievable. Every time I go in there, I'm just looking around at all the different things he's done. He's just, we could talk all day about Leo, but I want to talk about some things that are happening. Actually, today, you and I got on this call right after we heard Chairman Powell speak. I'm curious, what are your thoughts on what he said today? And we'll stay specifically into maybe some of your thoughts on how what Powell had said impacts the small caps.
Great question. And yeah, we were actually just watching Chairman Powell speak. I'm not going to obviously comment on his speech other than some really important points to give our audience things to think about. And that is the things that the Federal Reserve does, things that our regulators do, things that the government's trying to do. And what the key thing they're trying to do is, one, obviously, help this country and the world out of this pandemic that we're in. But secondly is the economy itself and bringing our economy back and bringing workers back. And as various lawmakers and our financial leaders like Mr. Powell are trying their best to keep this economy going and strong. And the best way to do that is to bring our workers back to their positions in companies. And small caps are those companies here in the United States, primarily. They're mostly domestic companies. So the benefactors of these incentive plans and things like small business loans being increased, or a new program being brought up by the House and the Senate to bring $3 trillion back to the economy in the United States in this next round, are all things that are trying to benefit our economy and these companies within the United States that bring back our U.S. employees. And those are small caps. So that's why you see the small cap index, the Russell 2000, step up and outperform other benchmarks in the marketplace. So you get the big swings to the upside with the Russell and outperforming as it's done in the last few weeks. Yesterday, obviously, it outperformed to the downside as the Russell 2000 stocks do. They're smaller in nature. The sectors are heavily weighted in things like financials and healthcare. Healthcare is one of the reasons the index has been outperforming as these numbers in the pandemic level off and improve. Healthcare is where more people will be able to get back to their jobs to do things other than help patients that have the COVID-19 or coronavirus. And these healthcare companies do other services that hospitals and other medical providers haven't been able to focus on that generate revenue for their companies. So that's why one of the reasons you see outperformance in the Russell 2000. So this index and the futures contracts at CME are just a tremendous vehicle to get in and out of that volatile index as an investment vehicle, as a hedging vehicle, as a speculative vehicle. And it trades in the hundreds of thousands of contracts a day at CME, and it's just a fantastic product for people to take a view as you hear things on TV or read about these in several of the newspapers online and in other places. But small caps react to these numbers in a big way. So I see the Russell 2000 as just being a tremendous trading opportunity for the trading community.
Personally, I trade the Russell on a regular basis, and it's really the only other product besides the E-Mini S&P out of the major indices that I trade. And it's really because on a consistent basis, it has pretty good volatility. Now, right now, everything's volatile. So, we're just in a crazy time. But in general, the Russell has consistently pretty good volatility. What are your thoughts on why the Russell is probably one of the more volatile indices out there?
Russell 2000 has various sectors that really drive the index pricing, and it has to do with the sectors and their weightings, right? So unlike large caps or NASDAQ, the NASDAQ, which is heavily technology weighted, the Russell 2000 has financial services and healthcare and producer durables and consumer discretionary weightings that are your top weightings within the Russell 2000. So these are all these smaller companies that are domestic in nature, and when there's and really tend to lead the charge coming out of recessions, as their business models are just quicker to respond to improvements in our economy. So small caps are those key drivers. NASDAQ kind of sometimes lead the charge, and then other markets follow. The fact that the weightings in the Russell 2000 are more on the financial and healthcare side and less in technology, it's not going to follow that big technology lead as you get into large caps and into the NASDAQ 100. So that's why Russell acts the way it does on its own, is because of those weightings. But it outperforms to the upside, but it's also very volatile to the downside because of those weightings. So it's what I like to call is a tradable, investable index that really represents the U.S. economy in a big way in these days.
Hey, everybody, a quick pause here to talk about FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small-cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures Contract, symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. Yeah, it's such an important market to watch right now. I wish that the mainstream media would talk about it a little bit more, because it actually has, in my opinion, it's actually more relevant to the U.S. market than maybe some of the other indices that are talked about on a regular basis.
Absolutely. It is definitely more U.S. revenue-based and less sensitive to global events. But there is a small piece of small caps that supply those bigger large cap companies in some way. So there is some global exposure in small caps, but it's just not as large as in large caps. But yeah, it's really based on the U.S. economy and the numbers here. Yeah, there's definitely global effects that impact small caps, but it's definitely more sensitive to U.S. events rather than global.
Yeah, I want to talk about the micros because we've actually had, just recently, we had the 1-year anniversary for the micros. And it's obviously been a huge success for all of the indices, the NASDAQ, the Dow, the S&P, and the Russell. How have you at FTSE Russell looked at the micros thus far?
Well, first of all, congratulations to CME Group. Micros has been the most successful launch of a futures product in their entire history. And it's quite an honor to be part of that launch with the Russell 2000 micros. We couldn't be happier with the performance of the product at CME Group and the volumes that we're seeing come for interest in Russell 2000 micros. It's been a tremendous growth, and volumes have just skyrocketed, and it's just really, really exciting to see. Not only is it the volume, but it's the diversification of who's trading the product, and the fact that it's global. So there's a major distribution excitement that folks in Asia are trading the product. There's numbers, volume numbers coming out of Europe, and obviously out of the United States as well. But the fact that this thing trades around the clock and has global distribution, and along with the sectors that trade, segments in the market that traded, and the fact that there's institutional interest in the product as well, tells you that the entire ecosystem is benefiting from Russell 2000 micros at CME Group. And we couldn't be happier that we're seeing this, and are very excited to see it continue to grow.
Hey everybody, a quick pause here to talk about FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small-cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 Index Futures Contract, symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. With everything that you're looking at on the macro side of things, do you think that we go back and test or even take out the lows made in March?
Yes, fundamentally. No, quantitatively. So right now, that's not within the probable bounds of Keith's risk range, but that could change. Certainly, it could change with a different volatility setting for the market. So right now, we've seen the VIX come from let's call it 80 all the way down to sort of what we would consider to be a very important signal level, which is around 31 on the VIX, specifically for the S&P 500. That thing held like a champ, this past week in terms of, kind of the market taking you to that level, sucking everyone back in, and kind of collapsing from there from a price perspective. And so, yes, in the context of our fundamental view, it's very likely the market could take out, its lows in the back half of the year as the credit cycle really starts to ratchet up, and you start to see, asset write-downs and charge-offs and equity issuance, and equity recapitalizations across a lot of these different sectors of the economy. That's something that we definitely see as emerging as a theme. And, when the market starts to price that in by, sort of sending a signal through the volatility channel is when you could start to have that conversation about taking out the lows. But again, we don't need to make a call that the market has to take out the lows on May 2nd. I think the call on May 2nd headed into next week is, did you appropriately position for, the market to continue declining? And B, did you appropriately position yourself out of all the things that consensus was forced to chase, over the last couple of weeks? And I think that those are the most important risk management things those are the important risk management setups that you can sort of apply to your portfolio at the current juncture. Because again, the market is impressively good at making people forcing investors to make the worst possible decision at the worst possible time. And I think at the highs of Wednesday, a lot of people bought into this sort of cyclical recovery narrative, or this V-shaped recovery narrative that's being propagated around by Wall Street and these analysts and PMs that have these Excel-based linear frameworks around how the economy works. And the reality is the world is a lot more nonlinear, as we've learned, and we're likely to continue learning as we progress throughout the year.
You said your goal was to get involved in trading, and you felt that the CMT was going to be a pathway to helping you become a trader. What did the CMT teach you?
Yeah, so the CMT, going into it, I probably had kind of a misrepresentation in my mind of what it really was. And I thought it was studying classical chart patterns, super basic, stuff like that. What the CMT teaches really is being able to design a portfolio, risk management, more risk management on top of that, and then how to design a strategy of money management that helps you no matter what you trade, whether it's stocks, whether you're a portfolio manager, a long-only equity fund, whether you're a futures trader. It touches on all these different topics that it doesn't matter what, like I said, if you're a classical technical analyst with chart patterns, if you're somebody who relies heavily on indicators, if you are more of a market profile connoisseur, it touches on level one, kind of touches on all these different aspects of technical analysis, Elliott wave. But it gives you that first level, gives you kind of a big overview of, look, you're a futures trader. You're probably going to want to focus maybe on volume profile and market profile. Maybe indicators like VWAP, basic moving averages can help you. And so it doesn't matter what you trade. If there is price and there's volume, the CMT program will certainly help you with that. And that first level kind of just is that breakthrough into introducing you to all these different ways within kind of the overarching technical analysis that you can manage money and manage your risk.
What I find interesting about this is that you went that route for the CMT to help you with your trading. And so many other people, I think, they really don't even consider that route, and they end up going to educators instead. I'm curious as to how the CMT program actually helped you become a better trader.
Yeah, so that's a great question. I was in at least one kind of educator type trading room before and during, actually, when I was going through the CMT program. And it was kind of funny because people would be like, why do you need that? That's kind of, theoretical. It's overkill. It's too much. But there's no way for me personally that I would have studied that hard and gone to that level of understanding of the material without signing up for this program. I mean, it's not like it's overly expensive, but if you're going to spend a couple $1,000s per level trying to find your way through this, and if you're a person that doesn't like to fail, you don't want to sign up for an exam and all your family and friends are asking you, what are you studying for? And then you go fail it. So you put yourself through this and you want to come out with a passing grade. And if I wouldn't have signed up for that, I would not have understood, kind of the necessity of a proper risk management approach. Before this, I was, on the average, I was gambling. I mean, I guess one could make the point that you're always gambling when you're trading, but I'm gambling with an edge, and that's knowing where I'm wrong before I get in, where my profit target might be, whether it's a futures contract or options or a stock position or whatever. And I wouldn't have known those things had I not kind of put myself through the gauntlet that's the CMT program. I know I sound like I'm a paid shill for the CMT. I'm certainly not. I get nothing for pitching it. But without that, for me, I probably would have gone through trading account after trading account because I was just, shooting from the hip without it. And it gave me the background and the basis I needed to be able to understand that you really should think about what you stand to lose before you think about what you stand to gain in any of this. And I've seen a lot of, traders over the years that have unfortunately gone the other way because they didn't understand the risk.
I want to dive in a little bit more about your strategy for trading options. Now, let's have a little fun with this. Look at someone like me. I'm an outright futures trader and mostly the E-Mini S&P. And I really consider myself more of an intraday swing trader, and I've been trying to find a way to implement options. And I've been saying this for a while on the show. Everyone's got to be like, Anthony, come on now, figure it out. But you know what it is? It's like once it starts getting busy again, I go back to what's made me money and go back to my comfort zone. I don't want to be putting on positions when it gets this volatile in when I'm not 100% sure of what I'm doing. So walk me through how you would maybe help me learn on how I could start utilizing options for me as a day futures trader.
Right. Okay. So what I would tell you, and what I tell clients that are like you, that are day trading or swing trading futures, is this. Now, the caveat is, in today's environment with the S&P volatility so high and the options overpriced, it's a little more difficult because the options are so expensive. But in more normal markets, it's actually a really great strategy. Is instead of buying or selling futures, you can use the weekly options. There's in the S&P, there's options that expire on Monday, Wednesday, and Friday. So every other day of the week, there's options expiring. So instead of going long a futures contract and placing a stop loss, which anyone that's ever traded futures knows there's a good chance you're going to get stopped out right before the market goes the way you wanted it to go. It just happens. I don't know why it does. But if you get a buy signal and you buy a call option instead, let's say the option expires tomorrow, and in more normal conditions, you might be able to buy that option for, maybe 10, 15 points in the S&P out of the money for $300 to $500. That's your total risk. No matter what happens, your total risk is what you paid for the call. It expires tomorrow, so you can get it cheap. You can get it close to the money. And if the S&P moves up 10, 15 handles, you probably pick up almost half of that, or at least a third of that. So it's just a slower way to do it. Obviously, it's not as exciting, but the nice thing is, let's say you get into the trade and the S&P drops 30 points all of a sudden and then rallies back. If you were trading futures, you probably would have been stopped out, but your option's still going to live until it actually expires. So you always have a foot in the door, and there's always a chance to recover. So it gives you lasting power. So that's one thing you could do. Another thing that I help my clients do is not necessarily buy calls or puts for speculation, but buy it for insurance. So if you really want to trade the futures, you could go long a futures contract and then just buy a cheap put for catastrophic insurance, just in case the bottom falls out. And you use that instead of a stop. And that too will give you lasting power. So even if the market, Trump tweets or something happens and everything goes wild for an hour, your put's protecting you. If things go back to normal, then you have a chance to recover, as opposed to being stopped out and watching from the sidelines.
A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Now they have integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. You could try it now for free at tryttnow.com. It's so funny hearing you say that you're a wheat trader, because now that I think about it, a lot of my friends that trade wheat, they call themselves wheat traders. They don't call themselves futures traders. I don't know that I've ever said I'm an E-Mini S&P. When someone's asked me this question, I never said I'm an E-Mini S&P futures trader, because they probably would be like, okay, well, what is that? And I've just always I've always said futures. But you're so right. It seems as though, specifically to wheat, that it's a real specialty in the future space. And you talked about how you look at fundamentals, weather. You didn't mention technicals, so I'm kind of curious, like how much of the pie is fundamentals, weather, technicals?
Sure, yeah. So, I mean, I probably have a sort of multi-pronged approach to trading, but technicals are probably like the least important. I mean, I never look at like moving averages or, stochastics or, all this kind of stuff. I mean, I do use charts, but mostly, I mean, I'm looking at probably daily, weekly, historical charts, right? So like, I'm very interested in historical ranges that's sort of as a part of my process to determine value, right? So I'm kind of like a fundamental value type of trader. So technicals to me are really it's kind of like, I mean, to be honest, technicals it's kind of like astrology to me, right? It's kind of entertaining, right? And it can be useful, but it's not something I really like believe in or really like commit like capital to. For me as a value trader, right? My sort of training and experience really comes from like working with like commercial grain traders in what is really like a commercial, like the Minneapolis Grain Exchange, the hard red spring wheat futures contract is really like a commercial contract as opposed to like more of that financial speculative kind of contract. So my approach is fundamental value, right? So for me, like the trend is not my friend usually, right? For me, I'm usually going against the grain, so to speak, right? So if we're in a downtrend and, you know, every day wheat's getting slammed, right? And funds are getting super short. What I am typically doing is looking for a spot where I can come in and say, okay, this is too far. We're into a value area, right? Based on, you know, what I see in supply and demand relative to price. And then I can come in and I can approach, you know, build a trade around, you know, getting long or bull spread or some combination or a relative value type of situation where I could be buying wheat and selling something else or buying one particular type of wheat versus another type of wheat. So that's kind of, whereas technicals are oftentimes is more about momentum, right? And so that's something for me that I'm very skeptical of, like that momentum strategy. And even just like with technical analysis, the whole concept to me for most technicals is that like what's happened in the past and whether your time frame is like intraday or, you know, the last several weeks, that you can kind of come up with some kind of calculation based on the recent past and then say like, okay, because of that, and I put it into this formula, it tells me that tomorrow the market is going to do this. Like I'm very skeptical of that. So for me, what's exciting about trading, and especially with agricultural commodities, is that really, you know, it doesn't matter what happened 2 weeks ago or what the market did yesterday. If there's some new fundamental input, market has to reprice today, and the past is not going to necessarily dictate what the future is going to do in terms of price action. So to me, that's like that whole technical piece is just something that I am skeptical of, and I don't really use in my practice very often.
So you talked about how you trade like between 10 and 15,000 contracts a month, and you're really kind of going against the grain, as you said, no pun intended. And I'm curious as to why majority of the traders that I talk to in the ag space, especially wheat, that pretty much all of you are trading spreads. Very, very rarely have I ever come across an outright wheat trader. Why is it that your method of trading is going against the grain and just spreading?
Well, so spreads are, for one, they're deeply connected to like the fundamentals, right? So when we're looking at like actual wheat, right, we're really concerned with basis and with like the convergence between the futures contract and the physical wheat at a delivery point. And so we're really tied into already like the storage economics, the delivery economics. And so that concern over like the fundamental actual wheat market really informs an opinion about what the spreads should do. So if you're dialed in to the physical wheat market and the cash grain market, then it's hard to not trade spreads, for one thing. But I think also that when we trade spreads, we can also kind of trade the flat price as well, right? So I mean, I would, even if you don't take any flat price positions, the flat price still it still affects spread relationships. It affects, you know, intermarket spreads, calendar spreads. So I would say, in a way, even though I'm not actually necessarily trading a lot of outright long short positions, I'm still trading flat price. I'm just using spreads to do that oftentimes. So if I think wheat is going to go up, right, then what you have to ask yourself is you have to say, well, what's going to go up the most, right? Or if there's, you know, if funds are short this particular contract, or, then that's going to gain in value, right, relative to something else, maybe relative to corn or relative to another part of the curve. And so there's, in a way, we're always trading flat price, even when we are trading spreads. It's maybe a kind of a roundabout answer to your question, but I would say that we really can't trade spreads without also being affected by flat price. And part of it is too, Anthony, is that, it's fun to trade a lot of volume. And so I think that's another thing that, like, in the grain markets, it's like, it's a lot more satisfying just to be trading and to be trading a lot of volume versus like taking a much smaller position. And then, and two, like the flat price, there's a lot of noise in that, especially on an intraday basis, right? There's a huge amount of noise. And that kind of random noise, that sort of random volatility, some people really like to trade off of that. And I think that's where a lot of like day trading technical kind of people, they operate in that, which to me is a lot of that is noise. And my edge really comes from my fundamental analysis of the wheat market. And so I have to figure out a way to filter out that noise. And so by focusing less on especially short-term flat price movement and getting into spreads, I'm able to really sort of take advantage of what I would consider as my edge in the market, right? And it sort of filters out some of that random variation and gets more into like the fundamentals.
For me, I always really accepted the crypto as a trading product. When crypto really first started, I didn't really look at it too much as a currency. I looked at it and said, you know what? I think that technically this is probably a decent product to trade because I don't know what else is it really going to go off of. I couldn't really look at fundamentals or anything like that. And I didn't start trading it right away. Bitcoin was out for several years before I began trading it. But right. A question I have for you is how old is Bitcoin now, right? I mean, Bitcoin is 12 years old.
2009, I guess.
So 12 years old.
11 and a half. Yeah.
Something I'm still not really sure of is it a currency? Is it a commodity? Is it a store of value? Is it all three? What is your take on that?
Yeah, so, it's a good question. I mean, let me answer from a regulatory standpoint, first of all. Obviously, we are a very regulated company, being regulated by the CFTC, the futures regulatory arm in the US, right, and offering futures on cryptocurrencies. So we view Bitcoin as they do as a commodity, right? That means it is regulated by the CFTC under a certain premise, and even fraud and manipulation of the spot market is under CFTC's jurisdiction. But they obviously are regulatory, the body of the futures, our futures market. So we definitely look as what products are we going to list, and how are we going to list them, what do they mean? We stick with the view of a commodity and things like that, rather than a security or any other type of asset class. So I mean, it depends on the different instruments, right? Bitcoin probably is more akin to a currency-like commodity in the way it's used. It's transfer of money, maybe a store of value and things like that, versus an Ethereum or Ethereum-like contracts, which are much more like utility kind of commodities. More akin to I don't know, corn, those things that, I mean, I guess you could say that with Bitcoin as well from a mining aspect, but Ethereum also has that component of its use case in the underpinning of smart contracts and things like that. So, in short, we really look at them as commodities, and that's how we go about deciding what to list and think, along our regulatory platform.
Well, you mentioned Ethereum. Let's just go there right now. You guys are the first to launch Ethereum futures. Why did you decide to do this, and how's it going so far?
Yeah, so let me start with the why, really. I mean, following on from your previous question, when we look to launch our spot market, we had a view that anything we want to launch as a spot contract, we'd love to be able to list as a future. So we launched spot back in April 2019 with the four instruments: Bitcoin, Ethereum, Bitcoin Cash, and Litecoin. And we know Bitcoin obviously had already been approved as a futures contract for CME and then ICE and CBOE in the time. So we really wanted to move forward and be able to start listing other contracts. So we've been working with the CFTC a long time with Ethereum. We commented on their public question earlier last year, and we've just driven that forward, really. So we wanted to launch it because we do believe in that value of a commodity to help price, underlying instruments. And that's where, the Ethereum blockchain, with its, use of Ether as the kind of gas, the fuel to drive, how you pay for the smart contracts, we definitely see that akin to like jet fuel or other things that people need to run their business. And so having an Ether-based future allows customers, miners, other people that you have a smart contract on an Ether blockchain. It allows them to have kind of price determinism of, we know how much we're going to have to use or may have to use over a certain period. We may know how much we're going to mine over a certain period, and they want to have a little bit less risk against the price movement of that value of Ether, and essentially, things like that. So we've been driving to push an Ether future so that people can really explore what it means to be able to hedge their exposure to underlying Ether, whether it is a fund who holds Ether, whether it is a miner, whether it is someone, as I said, who needs or their customers need, to use the gas on the Ether blockchain. So, how's it been? It's a brand new contract. We're a very new market, so it's a growth period. Getting people onboarded to our platform it's not a slow process. I don't want it to be thought like that, but it's not just scan your ID on a website and off you go. You can do that with our onboarding for our spot market. And I don't want to play down the approach we take for AML KYC, which again we have to because of money licenses and things like that. But getting to be able to trade futures has a lot more regulatory oversight from the CFTC. So we have to follow certain practices and make sure we do things according to what our guidelines on our rule book is. And in doing that, there's a little bit more interaction. We're a very customer focused kind of driven company as well. Customers who may have a problem onboarding, we're very engaging. We reach out to them, but then anybody is allowed to become a direct member of our exchange and trade our futures contracts. So going back to the adoption, it's growth right now. It's getting people onboarding, getting people into the marketplace, letting them explore, understand the contract. So hopefully we'll start seeing some really good growth over the next weeks, months, and we can be the prominent exchange for listing physical delivered assets on cryptocurrencies and other things.
Hey everybody, I want to take a quick pause and talk about RJO Futures. They are a long-standing brokerage firm with personal broker relationships to learn, discuss, and trade the futures markets. To learn more about RJO Futures, please visit rjofutures.com. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.